Hello and welcome back to another episode of Finance Agents Live. This is episode number 36, and today's show is all about me talking directly to, any one of our customers that we've ever had, because a common question that people have, maybe they're not asking it of us, because usually when people come to us, they're asking for money, but the question is, how much debt is good for my business, right? And so this is a decision that you really need to make on your side and that we're here to help people with. So we've got a bunch of different things we're going to be talking about today, but it's all about how much debt is good for my business. Darren, I need you to roll on those slides. I really have no idea what I'm saying unless the slides are up, right? So if you ever see me confused, it means there's no slides, and I'm just trying to think, what am I going to say now? All right, so don't get angry, Darren. All right, so if you're new to the show, if you haven't been here before, please subscribe or like me, the show. Your likes and subscriptions help us help more people, help us keep this ball rolling. But going on, back to the slides, Darren. You're rolling with the slides. All right, so first of all, when you're talking to somebody like us, any sort of loan originator whose responsibility is helping you get finance, one thing I want to say, and I just want to put it out there so that we're all aware of what the issue is. Whenever you're talking to somebody who's helping you, you want to be watching out for conflict of interest. All right, now this may seem counterintuitive for me to be saying this because frankly, we make a lot of money helping people get loans, and in general, usually, the more money we help you get, the more money we get. So we have an inherent interest in getting you as much funding as possible. That sounds, a little weird on your side. You need to know that the money is good for you. Our company has taken an ethos, or sort of our philosophy is that if you come to us looking for money, we're not making a decision on whether or not we think you have a good business. We're not deciding, do you deserve money or are you good for it? I got a lot of clients that come to us to try to convince me why they have a great business. We're not trying to decide if you have a great business. An example I've told a lot of people is that if somebody came to me to pitch Twitter as a business a long time ago, I would have thought, that's a ridiculous business. I don't think you should do it. And I would have been dead wrong. So we don't try to decide, do you have a good business? Can you afford funding? We have one goal. What can we get for you? We find it and we give it to you, and we'll get you as much money as possible. And because there's multiple ways to bill, we could bill a flat fee. We generally have, in advance, we have a back-end fee where we get paid on our success so that we know our interests are aligned. But in the end, the more money we get you, the more money it costs. So you need to know on your side, is this money good for my business? How much is good for my business? So that's what I'm going to be talking about today. How much money is good for your business? So it all comes down to one very simple calculation. And of course, nothing really stays simple. We'll go from there and dig into the complexities of it. But first of all, it's a very simple calculation of what is the benefit or return that you're going to get from the money. And that needs to be, at a minimum, greater than the cost of funding. Now that sounds like a real simple equation, and it can be if you look at it in a short time frame. But the things that you get from the funding can be varied, and there's a lot to that. And so a lot of the stuff we're going to be talking about today is what do you actually get from having the funding that is beyond just the basic numbers. With that said, in the end, if you're not making more than the cost of the funding, if you're not getting more from the funding than the cost, then inherently you have problems, right? And so that's what we're going to be digging into today. Darren? All right, so sorry man, Darren is lagging on me today, man. All right, how do you calculate your return on investment? There are a lot of different things that you got to look at in order to figure out your return, right? So first of all, in numbers, you've got money coming in each month. Let's do some simple math, right? Because it really depends on the type of funding, which helps you determine whether or not this makes sense. But how do you calculate the return? So if you're going to put out $10,000 in cost, you're going to buy $10,000 in a retail company. You may buy $10,000 of assets that you want to sell, right? In retail space, typically you're going to make 4 times the amount of money when you sell the item than the cost for you to buy it, right? If you buy a shoe, it costs you $10, you should be able to sell it for $40. That's sort of the retail metric. So your return on putting out $10,000 should be $40,000 coming back. That's a great return. And if you get a $10,000 loan and you can buy that and sell it within 3 months, and then you could do that multiple times, your return on that investment could be, you could be making 50 times the loan, literally, right? So if you get $10,000 and you're able to make back $500,000 by selling the money over and over and over again, you can get a huge return. So that is, when we're talking to a client about what their return is, that's what we're looking at. How much money are you going to make over what time period? Now, there's a long-term potential return on the business. You want to, that's obviously important. What's it going to mean to you to own the business? How are you going to be able to grow? What's the independence like? But if you always have to remember the short-term costs, is if you're not making the money short-term, if you're not able to service that debt, then the business is going to go under. So those are the balance, right? You want to look at the long-term cost versus the short-term costs. And so the different things you want to consider. By having the money, by getting this loan to open or grow your business, you're going to be able to benefit from the freedom of owning the business, but you also have the obligations of owning business. These are some of the things you want to balance. Having the money to start a new business you haven't had before, it creates future opportunities. It starts with this one business. Maybe you're able to expand into other businesses. There's a lot of future opportunities. Then, of course, you have to balance it with what's the impact on you and your family if the business fails. Of course, if you're getting a loan to start a business, you have the chance to create and pass on a legacy to your family. And then the biggest potential benefit, which may not be short-term, is long-term, the potential of building a business and selling it. And if you're able to sell a business after some time period, you're able to often, as long as you're cash flowing while you're owning the business, you can get a significant return at the end. So there's a lot of different factors to consider when you're looking at what is the return that you're going to be able to get from that. Now, if you go to a bank and you say, how much funding is good for your business? The banks have a very specific calculation that they look at. And what they're going to look at is they look at how much money you have coming in each month, how much net income. It's called net income. What's the amount of money you have left after you pay for all your goods and services and the cost to provide that? They look at that amount and they want that amount to be 1.2 times what your debt would be, right? So if you're making $1,000 a month, they want to make sure that that's at least 1.2 times your monthly debt payments. So let's say your debt payment is $800 a month and you're bringing in $1,000 a month, that would work. Or less, of course. If they can give you a $500 a month payment to $1,000 in income, they're generally going to be looking at your current income, which is great because once you get the money in, you should be making more money and you should be able to clear that hurdle very easily. All right, so one of the big questions you may have if you're starting a business or growing your business is, I've got something I want to do that's going to make me more money. I could get a loan for it. This is a decision point right now. I can get a loan for it, or I could try to bootstrap it, right? Let's say you're adding a patio onto your restaurant. You say, bootstrapping would be, let's slowly over time save up all the money from my net profit and then pay for the patio. And then the loan would be, let's get a loan and just get that patio done. What you really want to figure out is, what's the time constraint? So if you bootstrap, let's say it takes you 3 years to save up the money for that patio, or you get a loan or you can get it done in 3 months, now you have that patio for an extra almost 2.5 years. How much extra money are you going to have from the patio by getting the financing, right? You have a cost for the financing. The cost is definite. You know what the cost is. The future return is a guesstimation. But probably having that extra space, having those 20 extra tables it should far outstrip the cost of getting the funding. So that's the big question on bootstrap versus funding. So you need to look at the benefit of having something sooner. Of course, you want to balance it with the impact of risk, of course. And that's one of the things you always want to do. We want to adjust for risk. But some of the other things, you might be starting a new business and you're starting to grow and it's benefiting you, but you have competitors where if you don't get financing, you don't outstrip them, you can completely lose the market, right? So bootstrapping is great because it's very low risk. There's very low risk in bootstrapping. But except for the fact that the opportunity risk of what if you taking your time trying to be cautious means that your competitors box you out of the marketplace because they chewed up took up all the space. In the internet world, you see a lot of big competitors, big businesses that own the entire space. Facebook for a long time has dominated the space. And at some point there were probably 2 or 3 different or 100 different Facebooks, and the one that got the most funding, that was able to dominate the marketplace the fastest, secured their spot and now just buys up other companies like Instagram in order to secure their location. So there's a big balance between bootstrapping. Bootstrapping seems safe, but it can be very risky if you lose out on market opportunities like that. Remember, when you're looking at this, you have to adjust for risk, right? You're looking at your future potential. But the more time, the longer that loan is. You got a 1-year loan versus a 3-year loan. The 3-year loan is often a lower interest rate, but it might be the same risk because over 3 years, you don't know what's going to happen. Over 3 years, it increases the chance that you might have illness in the family. There might be something that impacts the business. The entire market may change. Maybe you're in real estate and the real estate market can turn. It's less likely to turn in 1 year than 3 years. So sometimes you have a short-term interest rate that seems higher, and it's actually less risky than a long-term rate that's lower, right? And just because of the risk of time. So when you're thinking about adjusting for risk, it's good to, I put some numbers on a slide here, but really this is just, you're going to have to adjust this. What you want to do is try to think of, all right, let's look at this example, something I'm going to be doing, and break it up into possibilities. So what's the possibility? I have best case scenario. A moderate success means you're making money and you're paying your bills. There's a break-even business where you're just barely paying your bills and you're not having any extra money. And then there's a total default on debt, right? I put 25% on each, but it really depends on your business. What you want to do is you want to sit down and think about these numbers and create how you're going to adjust the risk, right? If there's a 50% chance you're going to default on that debt, then the other options need to have a super high benefit to adjust for that risk. There's a lot of different types of funding that we help people get, and they come with different types of risks associated with it. So I'm going to talk about that a little bit because the type of funding you get has a big impact on how you adjust for risk. All right, so the first one is a 401k rollover. 401k rollover means I'm taking retirement assets and I'm investing in your business. In one sense, that has a very low risk because you have no interest rate and you have nobody to default on other than yourself. In that sense, it has the lowest risk possible out of all of our types of financing. But with that said, it has a high risk because if you lose that money, it is gone. With other types of financing, there is always the possibility that you could file bankruptcy and offset that risk. So in that sense, if you lose the money, it's gone. So in that sense, it's high. But as far as defaulting, you have a low chance of defaulting on some sort of a payback. And when you pay the money back to yourself, you're paying the return back to yourself, so you benefit from your own type of financing. So that's 401k rollovers. Unsecured finance, which could be business credit cards or lines of credit, have low risk because the interest rate is low, and if you pay the money back each month, you have a very low cost, super low cost, and you can fluctuate it over time. It's high, it can be high though, because these can stay around for 30 years, and you don't know what's going to happen in the business over the next 30 years. All right, personal loans. Personal loans have a moderate risk because you have to pay back the money over a fixed period of time, so it's inflexible. And the nice thing about unsecured lines is that there's flexibility. If you have a bad month, you pay the minimums. If you have a good month, you pay more. But personal loans, you have a fixed return. So that's why it's a moderate risk, because it's inflexible. But with that said, the interest rates are normally low, and so it's usually something that's easy to debt service. Real estate loans have a low to moderate risk. The interest rate is often much lower than other types of financing. That's one of the reasons it's low. But we put moderate on there because if you default on it, you could lose the real estate, and that's a very real concern that you want to consider. Equipment finance has a moderate risk because you're going to be guaranteeing the debt with the equipment itself. And so if you actually go into default, you could lose the equipment, but often you don't lose other things. It has less of an impact on the rest of your business. So you'll lose the asset, but you won't necessarily lose your business. Some other types of funding can have a dramatic impact on the business if you default. Working capital has a high risk because it has a very high interest rate. You have to pay it back very quickly. And the working capital lenders, we're talking about daily payment loans, are very aggressive in their debt collections. So I put that in the high category for risk. So if you're going to be doing working capital, you need to have a high benefit because it's high risk and high rate of interest. And then last but not least, business term loans. There's a lot of variability on these. The biggest reason why I put low to moderate on business term loans is that they tend to be for a longer term. And while everything can be great for your business and the economy right now, if you look at it over 5 years, you don't know what could happen. You don't know what could happen to you. You don't know what could happen in the market. There could be big changes. All right, let's talk about one of the terms you can hear a lot, which I feel like people get a little confused about when calculating the cost of financing, and that's APR. I think most people assume APR is the annual cost of the funding, which basically the interest rate. I think a lot of people don't know is that when you calculate the APR, they also add in origination costs and other costs, and then they annualize it. This is great for multi-year debt for understanding the real costs, but it can be super confusing and misleading on short-term debt. All right? So I'll give you an example of APR so you can see the difference between a shorter term and a longer term. Let's say you have a $100,000 loan for 1 year and a $100,000 loan for 5 years. Both of them come with an origination fee and loan documentation fee, which ends up being about 5% of the loan, and both of them have a 12% interest. So it's the same loan, but one's over 1 year and one's over 5 years. If you calculate the interest rate, it's 12% per year, but if you calculate the APR, in the 1 year loan you have 17% because you had to put 100% of all those extra costs into 1 year. But if it's 5 years, you only have a 13% APR. So that's a description of how the APR changes based on the timeline. And if you have a very short-term loan, like a week, any sort of transaction cost that goes on there inflates the APR to the point where you can't recognize it as a real determination of the cost of financing. Also, the smaller the cost of financing, or the smaller the financing is, the bigger a portion those transaction costs are going to be on the funding. So if you get a $1,000 loan and there's a $200 origination fee, it's a significant percentage of the loan. If you get a $100,000 loan and there's a $200 origination fee, it's a very nominal cost. But either way, it's just $200. So that's the APR can confuse that type of financing. All right, let's talk about the current market. We're going to go through the different types of financing that we offer and give you some examples of the 5-year costs or the APR. Again, you want to understand the one thing that you could definitely calculate is the cost of funds. That's easy to calculate. We talked, for a while about understanding the return to you, and that's could be so broad and there's so many different factors that it's hard to give you a real number. So that's why, we kind of went around in circles a little bit, but it really comes down to you figuring out what's the real value to have in the financing. You're going to have to make that determination on yourself. But the cost of financing we can be very clear about. So 401k rollovers. Let's say you did a 401k rollover. There's a $54.95 cost to set up and $1,000 a year to maintain the corporation. That, over a 5-year period of time, ends up being about 20% APR on your money, assuming you had $100K in funding. Now, if you have $1 million in funding, it's much less. It's maybe 2% APR, right? This is one of those examples of the more money you have, the more the transaction cost has an impact on the cost. So here you got an example. You're getting 20% cost of money. If you're doing a retail business where you're able to do 100% return in the investment, the cost is 20, the return is 100, your end final return is an 80% return on the investment after all costs. That is a win. That is a good business decision. And this is an example of how we're doing the rate and the return together. All right, so that's the 401k rollover. Let's talk a little bit about unsecured business lines. Unsecured business lines are weird because you have an origination cost to set them up. Often they come with a promo intro where there's no interest rate. And then the long-term interest rate can be anywhere from 9 to 19%. I put 20% on here just to put a number down. But the interesting thing is you can borrow the money. If you pay it back each month, you effectively have zero cost every month. So it's a flexible term asset where you can use the money at no cost. Or if you, on an extreme, you just use it like a loan and you pay it off over 20 years, then you're looking at a 24% APR calculating in the origination and the interest rate over a 5-year period of time. So those are the extremes. It can go anywhere from a 2% cost, because you're just offsetting the origination over 5 years, or a 24% cost if you maxed it out and just paid it off over time. Most people we see going back and forth, using the money, pay it off, using the money, pay it off, and it keeps your cost very low. All right, so that's 401k and unsecured business finance. Personal loans are very easy to calculate. So let's say you had a personal loan over a 5-year period, the 10% origination, 10% interest. You know your cost is going to be 12% over 5 years. Again, in the retail example we said, if you're able to make 100% return on your money in a year and it costs you 12%, because it's a 5-year loan, you could probably do that multiple times over 5 years. It is a slam dunk decision in order to get financing. And in fact, I would get as much as you possibly can, right? As much money as you possibly can, because you can get so much higher return than the cost. And then the only other factor to take into consideration is, what are the variable risks over time that you're not going to be able to make that return? But maybe the best thing to do is pull that money, pay it back as quick as possible, and then do your additional retail purchases with all the profits you made from the first couple times you did it. All right, real estate loans is an interesting one when you're looking at risk and return, because I see a lot of people are misinformed as to what are the actual costs of real estate and what makes sense. Everybody knows a mortgage loan, 4 or 5% these days, but that's if you're buying your own house you live in for a 30-year loan. The real estate loans we're doing for business owners tend to be around 12% interest. Sometimes they fluctuate based on that. That may seem like a lot, but really it isn't. It's so much cheaper than the other types of business financing. But if you had a real estate loan with a 5% origination and 12% interest over 1 year, because these are usually a 1-year bridge loan, the cost is 17%. That is 12% plus 5 is pretty obvious. So again, if you have a use of funds that generates well in excess of 17%, right? Like if you're buying a business where you can double your money in a year, which it happens, then it definitely makes sense to do the funding. And frankly, take as much as you possibly can, because if you make more money with more money, then max out debt. A lot of people if you have debt, you want to get as much as you can within risk, all right? As long as you adjust for risk. All right, equipment finance. That's the next category we're going to go over. Equipment finance tends to have very low origination fee, which is good. The interest rates are all across the board. I've seen anywhere from 5% to 30%, so it's a big range based on your business scenario and how strong of a borrower you are and what other assets you have to collateralize it. Typically, you're going to pay over 3 to 5 years, and one of the interesting things is you'll notice that the payments coincide with the rate that you can write off the asset in taxes. I won't go too far into that because it's a little confusing, but if you were able to buy the asset, you can't write off the whole cost the first year anyway, so it makes sense to do it, pay for it over time. But again, so you have to look at that one individual piece of equipment. If I get this piece of equipment, how much more money am I going to make, right? That's how you look at equipment. So if you get another truck, and that truck is going to cost you, making up numbers, $10,000 a month, but having that truck on the road is going to generate $20,000 in income per month, then it makes sense. As long as you adjust for the variability of what if the truck goes off the road for 2 months because the driver's down or breaks down and I can't fix it. So that's the risk factor on that. All right, working capital. Let's say you get a working capital loan, daily payment loan. You're going to have potentially 1 to 2% origination, sometimes more in distress scenarios. Your interest rate could be 12 to 100%. It's a huge range on working capital loans. You want to be real careful on these. You got to pay them back over 6 to 12 months. This is frankly a difficult one for people to justify. I see a lot of people take these loans because their business is in a tough situation. And in general, if you're trying to take one of these loans because your business is in a tough situation, you really should be looking at the numbers, right? Maybe you're saving it because you're going to have a great year next year and you're able to pay it all back and then it makes sense. But if you're just trying to grab out straws as you're on the way down, maybe it's better to start looking at the current debt you have and ways to settle it or try to offset it so you can save your business. Because once you get in with the working capital lenders, they can be very aggressive. So if you're looking at getting your second or third or fourth working capital loan at the same time, you're starting to get in some really dangerous territory. And again, I'm not here to tell you what to do for your business, but you really need to look at the numbers and start thinking about what your alternatives are to see if those alternatives are better. When I say alternatives, the alternatives may not be other types of financing. The alternatives might be strategic default on some of your debt, or trying to segment your business in order to prepare yourself for impending default on debt. Defaulting on your loans sounds horrible. Nobody wants to do it, but sometimes it's better than taking on more debt and digging yourself into a bigger hole. All right, and last but not least, or last but most really, business term loan. We love these because you can get a loan for 5, sometimes 10 years. If there's real estate, sometimes 25 years. And the interest rate is very low, so they're very attractive. And so I don't have an exact calculation because you can there's a lot of variation of what the rates are. But again, you want to look at the return and remember to reduce your potential return for the risk of having something for 5 years. That's what I'm saying. If you see a lot of variability, you want to be careful and adjust for that. All right, so that was going through the different current market or the different rates. In the end, it's got to come down to what's a good decision. One of the things I want to mention, which is a very important factor in making business decisions, is that you're going to sit down, you have imperfect knowledge of the future. You can't know what's going to happen. You can make the right decision, and it could lead to a negative outcome, right? If you have a 75% chance of success and a 25% chance of failure, it probably makes sense for you to take the decision to move forward. But if later on it fails, don't go back and say, I made the wrong decision. You can only judge the decision based on what you know at that time. If you have a 75% chance of success and you end up failing, it doesn't mean it was wrong to take that step. See, a lot of people get stuck in the decision mode of, I don't know whether I'm going to move forward, or they're beating themselves up for decisions in the past that failed. Just because it failed doesn't mean it was a wrong decision. It just means it failed, right? That's called life. Sometimes you walk down the right road and you fall down. So, all right, we have a few different questions that have come up over time that people have asked us when, in reference to, is this kind of financing I should take? Should I do this? How much money should I take on? And one of the questions is, should you take on more debt if your business is losing money? Now, that's a big question. I can only scratch the surface because we could easily do a whole show and a discussion on should you do this. But there's two sides to this. I'll talk about that real quick, and then you'll have to make your own decision. The one side is your business growing rapidly? Your business could be growing quickly and losing money, and that could be a great thing. People that bring on investors often do this. They bleed money because they're growing like crazy, and by investing money, they may have a negative return at the end of the year, but they're growing a significant business. But if you're going to be doing that for a long period of time, you can't keep doing that with debt. You need to bring in investors because eventually you're going to have a problem with the debt. But if you look at Amazon, for example, one extreme outsized example, they have lost money almost every single year since they've been founded, but they are having such huge success, nobody can ever criticize them for losing money because they're doing amazing stuff in the marketplace. So if your business is growing quickly, it might make sense to take on a lot of debt and lose money for a couple years as you grow. Now, the other side of it is, are you losing money because you have an unsustainable business model? Maybe taking on more debt is not going to help you get over that hump. You need to really decide and run the numbers and figure out, is there a way that this is going to work out with some certainty, right? Because sometimes just taking on more debt just puts you further in a hole. Remember, the more debt you take, the more money you got to make each month just to do your debt servicing. So it's an important decision that you're going to need to run the numbers on yourself. All right, here's another interesting topic. What are the true impacts of defaulting on debt? This really varies widely. Now, ethically, we would never advise somebody to take on money that they knew they were going to default on. And that's just, we would not do that, right? So don't do it. Don't take on debt with the intention of defaulting on it. So let's just start there. Nothing I say is telling you to do the otherwise. But when you're trying to analyze the risk of whether or not you want to take on this money, you think, hey, in this 25% chance that I default on the debt, it doesn't even, if you really analyze the impact of that, it doesn't even mean that you would lose your business. You can totally default on all your debt and keep your business. Now, if you have a retail business and you get kicked out of your location, you're out of business. But if you have a service business where you could do it out of your garage, if you are willing to work for free, nobody can ever take your business away from you, no matter what happens financially. So if you default on your debt, some of the things are going to happen. You might get sued. You might end up racking up more fees in legal fees for getting sued. But if the end goal is you want to have a business and nothing else matters, defaulting on the debt will not take you out of business. You can still have a business as long as you don't lose. Each business has core things that you just cannot lose, right? So make sure you don't lose those. But when you're looking at the true risk, defaulting on debt does not necessarily mean you've lost your business. All right, I think we have one more question on here. Nope, maybe? All right, why is long-term debt riskier than short-term debt? We did talk about this a little bit before, but it really comes down to the increase. If you have a risk, if there's a 10% chance of something affecting your business within the next year, so that's a 1-year risk rate. If you go to 3 years, it doesn't just go from 10% to 20% to 30%, it increases more than that. From 1 to 2 years, it might go from 10 to 30%. From 1 to 5 years, it might go from 10 to 50%. You don't know. Different businesses have different fluctuations based on time. Like, I remember there were a lot of people right before the real estate bubble collapsed. They were thinking, I'm strategically investing, but if the market starts to turn, I'm going to have time. I'm going to be able to get myself out of the situation. They had way less time than they actually thought. When there's a market correction, sometimes it can come fast. And so adding that extra year or 2 years or 3 years can greatly increase the risk. All right, Joe, who's on here, is saying, I found that people really light up when you say hard money lenders. Light up. Can we really get money from people with marginal qualifications? Okay, so I'm going to assume by light up you mean positively. One of the good news with our hard money loan product, hard money meaning private loans based on the equity in your real estate. Yeah, you can get somebody, almost any scenario. Somebody can be in bankruptcy and be able to get a loan to get out of bankruptcy. You can be in foreclosure, and if there's enough equity in the property, you can do a foreclosure bailout. We've helped a lot of people with interest rates under 500, a FICO score under 500 in order to be able to get a hard money loan. So definitely that's possible. And if you're losing your house already, owner-occupied properties, let's forget about those because we don't really do those, but let's say you have an investment property and you got behind on the payments and you're going to lose it because you're 3 months behind, and you can get a hard money loan to pay it off. The cost of the loan may be expensive, but it's not as expensive as losing your property or having to sell it in a fire sale. So that's a risk return on that one, something that you have to calculate. But yes, we can help people in almost any scenario as long as there's sufficient equity in the real estate. And by sufficient equity, normally the final loan of all debt can't exceed about 50-60% of the value of the property. So $1 million property, let's say you have a $300,000 loan against it, and they're in default, going into foreclosure, you can get them a new loan and get them cash out of maybe an extra 200 grand. So a final loan of 500 grand. They could save their property, pull it out of foreclosure, set aside debt payments for a year. That gives them enough time to maybe rehab the property and get a new renter in there. So then they're cash flowing and they save the scenario. Joe's asking, do we need a title search and appraisal for real estate loans? Almost always. We need title for sure. You cannot do a loan without verifying title is clean on real estate. As far as the appraisal, sometimes if something comes in with the appraisal, we can use it right away. Or there are scenarios where we can get a broker price opinion, BPO, instead of using an appraisal, so there's some variability. In general, we will want an appraisal, but there are exceptions. Like I said, if you have a recent appraisal, we can often use that. Or some of our investors are comfortable doing a quick loan based on their knowledge of the area. That's another one of the exceptions we have. All right, so it was kind of a long show. I talked about a lot of different things. Figured out whether or not it makes sense to take a loan from your business is always going to be a little bit complicated. There's a lot of factors that I just put down there. It depends on your business, depends on what you're going to get for the money, depends on the risk of your industry over the timeline of the funding, and it depends on the total return you get for the money and the cost and type of financing. If you're confused by all these things, the easiest thing to do is just call us up and we'll explain what's available and go through it with you together. And then show you the numbers. We show our customers the numbers, and again, in the end, you're going to make the decision, does it make sense for you? Brett's on here. We wanted to point out the top funding source in any one of our offices. We have a lot of options for startups. So, of course, when you're doing a startup, you have a greater risk. You don't necessarily know what the return is going to be. Unless you're buying into an established business or business opportunity like a franchise or something where you've seen it's proven over time, you know the market exists, and that helps offset that risk. If you're buying into something existing, it makes even more sense to do a startup. Or if you're doing something that you know works, it brings down the risk and increases the chance that it's a good decision for you to get funding for your business. All right, if we have any other questions or anything, feel free to go ahead and put it in there. I'm probably too late. Let's go ahead and wrap it up for the day. Thanks, everybody, for coming on the show. We do have...
hey, don't forget, we have a prize to give away.
A prize, all right. I should have said this at the beginning of the show, but if you're still in here, we have a prize for anybody who listened to the show and you got something that was useful out of it. If you heard a good quote that you thought was beneficial to you, then we're going to give a prize. We're going to give out a Chromecast. So whoever listens to this show pulls out the best quote, something that they thought was interesting or educational or worked for you, put it in the comments below the show, and we will send you out a Chromecast. By next week's show, we'll determine who the winner is. We'll announce it on next week's show, and we'll send you a Chromecast. We're going to be doing different prizes each week for whoever pulls out the best quote or two from the show. So looking for those quotes. Thanks, everybody, for coming on, and we look forward to doing a lot more deals together. Don't forget to subscribe or like the show if you liked it. All right.